Week 8 of documenting my trading journey. This week, I focused on creating a strategy that was profitable before optimization to avoid backfitting to the sample data. Today, we're going to go over last week's goals, the sentiment from this past week, the momentum and mean regression strategy that I created, a strategy that was profitable out of the box before optimization, logical fallacies that beginners tend to run into, takeaways from my reading, and then goals for next week. So last week's goals: develop a regime-based momentum and mean reversion strategy, and then create a strategy that is profitable before optimization. I knocked both of those out with the same strategy. And then explain quant logical fallacies. We will get to that. What I've been thinking about this week is the mental battle of just getting it done versus understanding it. At first, I was really focused on just get it done, just get stuff down, work through different things, fail fast, learn quickly, which is great, and I think that was the right move. But now I'm getting to the point where I'm realizing I skipped over some steps and I'm lacking a depth of understanding. So I think I now need to slow down, work back a bit, and fill in those missing steps. Now we're going to look at that momentum and mean reversion regime-based strategy. So these were the constants that I used, and as you can see, as I'm looking to avoid overfitting, they're all extremely basic and round numbers. For example, for SMA, we have 200, RSI 14, just the most common variation of these different constants. These numbers are pretty arbitrary, and that's on purpose so that I can see if the strategy actually is worth its salt. So this is the momentum part of the strategy, and what it does is it checks if price is above breakout price, and it checks if price is above the simple moving average. If either of those are true, that is a condition to take along, and then if price comes back below the simple moving average, it will then exit the position. So this block right here is essentially the whole momentum strategy, and that is the goal, to keep it simple. Here we have the mean reversion part of the strategy, and this is for a bear market regime. This follows very similar principles to the momentum one, just with different variables. So here, if price is below the lower Bollinger Band, or RSI is below 30, then those are the conditions for entry into a position if either of them are met. Now, when in a bear market, using the mean reversion strategy, the positions are smaller than in a bull market using the momentum part of the strategy. The exit conditions are if the RSI is greater than 50, or if price is greater than or equal to the 20-day simple moving average. So I previously outlined some of the exit conditions for the momentum and mean reversion parts of the strategy. There's also a volatility-based safety net for exits and for stops, as shown here. And so it's based on ATR, measure of volatility, and then if price breaks to a certain multiple of ATR, then the position is exited. And this is to avoid catastrophic losses, which the strategy does incredibly well, as we'll see when we look at the results. This section does a similar thing of trying to avoid catastrophic losses. If the drawdown is greater than max drawdown for that day, it liquidates all positions and goes risk off for that day. All right, so that's what the strategy does. Now, was it profitable out of the box before optimization? Yes, in fact, it was 12% return. As we can see, we have an up and to the right equity curve. Very exciting. One thing to note, though, the 12% return over this period, a buy and hold of the S&P would have generated a 70-something% return. So it is not very profitable compared to just a buy and hold of a benchmark. However, I'm not too mad at that, and we'll see why. And then just as context, 99 backtests remaining, it starts at 100. So this was the first backtest. 0 parameters detected. There was no grid search, no exhaustive search, genetic search. None of the parameters were optimized. And so, this was just out of the box. The original strategy created, tested once, and then it was profitable over that relatively long period, over 5 years. So yeah, like I mentioned, our strategy was profitable, returning 12% returns, net profit, after fees. The benchmark went up over 70% in that same period. However, I think there's still great value in the strategy. And that has to do with drawdowns. As we can see, the max drawdown of this strategy was this section here, and it was 2.46%. That is not very high. Hedge funds have to optimize for very little drawdown. If you are like me and you're just one person, but you want to trade prop firms, you also have to have very little drawdown. Small drawdowns are almost equally as important as profit. That is part of what this strategy does so well. The drawdowns are not very large. It is not smooth yet, but it is definitely less volatile than a buy and hold of the benchmark. So remember, our max drawdown was 2.46%. The S&P, here we see already over a little less than a year, 24% drawdown back in 2022. Then here, in only 3 months, a 17% drawdown. And again, in 1 month, a 8% drawdown. That doesn't even look large on this graph, but that is over 3 times what our largest drawdown was. So although we did not beat the benchmark in net profit, we were definitely close, if not actually beat the benchmark significantly in terms of volatility. And I think the reason we were able to achieve that is the regime-based strategy. Now, the momentum and mean reversion specifically, not necessary, no magic sauce to them, could use entirely different principles. I think the principle as a whole of just a regime-based strategy is crucial and something I definitely want to use from now on. And this just illustrates why this lower volatility can be so important. We see after this big drawdown that was about 24%, it took over 2 years to just break even. No returns. Over 2 years to just break even on a buy and hold. So yes, obviously, long-term buy and hold of the benchmark, much more profitable. But if it's something like a hedge fund or a prop firm that someone is strictly looking at their drawdown, scrutinizing their drawdown, a strategy like the one that we just developed could be very useful. So now, like I mentioned, I had been just go, getting my hands dirty, and I think I skipped over some steps of knowledge. So now I want to go over some common pitfalls to hopefully educate myself so that I can avoid these in the future. This first one I have 100% noticed and been talking about a lot, and that is backfitting the sample data. That's why this past week I wanted to create a strategy that was profitable out of the box. This is essentially my biggest fear right now in strategy development. Overfitting the sample data and then the results just not being translatable to out of sample data. This image brings up the concept of noise versus signal. Kind of goes to human nature. We're really good at finding patterns. If you're looking for patterns, you're gonna find them. And so you can find patterns in noise. I think I mentioned somewhere here the correlation between butter production in Bangladesh and returns in the S&P 500. You can find patterns in the sample data, essentially always. That does not make it translatable, and that is why I want to focus so much on not overfitting, using out of sample data. The biggest bridge that I'm on now is I did optimize this strategy using a grid search and optimized the different parameters and got incredible results, but it was completely backfitted to that sample data. Then, just recently, I created a strategy that was profitable out of the box on out of sample data, but it wasn't optimized at all. It could probably be better. And so I need a way to optimize a strategy without overfitting it to the sample data. I think that is something that I should be looking for in the near future. This is one I had not thought about at all. Look ahead bias. So using data that would not have been available at the time. And so this main example, if you're using time series data, and then you accidentally use T+1 instead of T-1, obviously you wouldn't have data for tomorrow if you were live trading. That one seems easy to avoid. One that seems much harder to avoid is stuff like this. earnings reports that, in retrospect, they're all available because they've all come out. However, as it mentions, these are not always going to be available before market opens. So it mentions, way to catch it, a point in time database. What are those? Where are those? How in depth do they exist? How much money are they? They're probably pretty expensive. I'm not sure, and so I'm gonna have to look into it more, but I'm not too sure on how to overcome this. So far, my strategies have been more price action based rather than global macro events. So it hasn't come into effect as much, but I think I would like to move into some strategies that are based on global macro events. And so this would definitely need to be one of the biases, pitfalls that I'm aware of. Pitfall 3, transaction cost and slippage. This is one that I was made brutally aware of when trading on TradingView for the first time. The spread between bid and ask price was just a nightmare. That was a brutal awakening of the chart, the price that you're going to see on the chart. Say that's here. That's like a phantom price. It's not even real. That is the center of the bid and ask price. And then I would see this price right here, the average price, and I would want to take a trade. So I would put in, say, a long, and then I would get filled up here at this ask price. And say my TP was here with a stop loss here, and all of a sudden I have a 1-to-1 risk to reward ratio. And that was just, I was thrown off so aggressively. Like, wow, okay, that is real. Bid versus ask price, huge one. The spread, the commission costs. Luckily, a lot of these softwares that I've been using have factored them in for the backtests and give you the option to increase or decrease the fees, commission, slippage that you're factoring in. So you can factor in this much, or you can factor in more as well. Still something good to be aware of though. Fourth pitfall, P hacking and multiple comparisons. So P is in P-score. You're testing the significance level. A significance level of 0.05 is very common. And so if P is below that, you say it is statistically significant. And what that's indicating, that P-score, is the percentage likelihood that the results were due to chance. And so that's the example it gives. If your P-score is 0.05, that is statistically significant if you're going, less than or equal to. But that's still 5% chance that it can be attributed to chance. And so out of 100 random strategies, you would still get 5 false positives. So what's the solution? I don't have a clue what a Bonferroni correction is, but I could potentially figure it out. And using out of a sample tests and pre-registering the hypothesis seems like a much more approachable solution to this problem. This is one I definitely need to pay attention to: regime blindness. Especially because a lot of the free softwares that I'm backtesting on only allow you to go so far back in terms of historical data. So I can't go backtest in the 1900s. That may be valuable. The market moved differently in different periods. But this is again why I now believe that a regime-based strategy, or having multiple different strategies for multiple different regimes, is so incredibly important. Here's the example I mentioned for confusing correlation with causation, the butter production in Bangladesh to S&P 500 returns. However, I like the fix here. Makes sense. Do you have a trading hypothesis, an investment thesis? Is there a reason why this would work? Or did you just mess around with a bunch of parameters and find a pattern in the noise? This makes a lot of sense, but it's definitely something I should take into practice more. Actually, writing down what the hypothesis is, why I believe this strategy would work. So the main two I think are notable here are BNC, Sharpe ratio, tunnel vision. If you're maximizing for Sharpe ratio, ideally you just need super high net profit, but that doesn't take a lot of things into account, like maximum drawdown being one of them, and then another one being time frame. You can have a super high Sharpe ratio over a short time frame, but then you drag that out and it just completely changes. Next being survivorship bias. This is one I didn't even think about because so far I haven't been trading individual stocks, but again, this does make complete sense if you're trading stocks that are companies that are very successful now, and then you backtest the strategy. Well, of course, the curve is going to go up and to the right. The company went up and to the right. You know that. That's why you picked the company, because it's successful. I'm not sure what the solution would be there, but definitely just something good to keep in mind. Takeaways from my reading: everybody's talking about the SpaceX IPO right now. That is the huge thing in the market, most important IPO of all time. Potentially would make the first trillionaire in the world. Everyone's saying it's extremely overvalued. However, it's seeming like the valuation will come to fruition. Bloomberg did report that there have been institutional orders for over $10 billion and plenty of them already. So it's looking like his absurd valuation of like 1.7 trillion will actually be hit, which is going to be crazy. I have never watched the process of an IPO before, the effects, what happens to the market, and I haven't read much about it either. So I really have no experience. For me, I'm going to sit this one out and kind of watch what happens, but I am excited to watch what happens. And something interesting that I read is the effect of institutional versus retail advantages. So there are these $10 billion institutional orders, but they have a drastic advantage of having the resources to be able to get in early. Now, I think Elon mentioned that he was going to be setting aside some shares specifically for retail investors. However, I heard someone else mention that for it to make sense, for it to be profitable for a retail investor, SpaceX would essentially have to live up to its Fantasyland promises. It would have to build data centers in space and have them be more efficient than the ones on Earth. It would have to do something crazy to justify that $1.7 trillion valuation. Now, why it wouldn't for the institutional investors for it to make sense, I don't understand that. I should read into it more because I'm just echoing what I'm reading. I don't really understand it still, but that's why I'm excited to watch. I'm excited to watch it. I'm excited to see what happens. All right, next week's goals: deploying the profitable strategy that we went over today live in real markets, explaining options. They seem really complicated, but they seem really cool, and then plan for the imminent bubble. As always, continue reading about finance and the markets as a whole. Lastly, important to remember, this is purely a journal of me documenting my learning. It is not meant to be educational, not advice, and I am in no way an expert.